This is the 8th episode of the Impact Principles webinar series. My name is Diane Damsky, and I'm head of the Secretariat of the Operating Principles for Impact Management. These webinars are designed to enhance knowledge about impact investing, share and promote best practices, and support the growth of the impact market based upon the discipline and transparency established by the impact principles. Today's topic is impact investing in public equities. Most of the current impact assets under management are in the private markets. However, publicly traded equities and debt represent the larger part of the investing universe, and mobilizing more of this capital to achieve positive impact would help meet the global challenges we face. While there are many sustainable listed equity funds, there are very few that invest for impact following the framework laid out by the impact principles. The market needs to be able to distinguish between strategies designed to contribute to positive, measurable, social, or environmental impact alongside financial returns from ESG-aligned or sustainable investments. Now, in 2019, the GIIN convened a listed equities working group to begin to define best practices in impact investing in public equities. Their paper, published in June of 2021, summarizes these findings. One of the observations from this paper is that there is no single, easily identifiable indicator that qualifies a listed equity strategy as an impact rather than a sustainable strategy. To help clarify what it means to invest for impact in public equities, I'm very happy to have with us today a panel of experts on the topic. First, we have Sean Gilbert, Chief Investor Network Officer from the GIIN, Andrew Lee, Global Head of Sustainable and Impact Investing, and Quyen Tran, Director of Impact Investing and Head of Sustainable Investing Research for Fundamental Equity. And with that, I'd like the three of you to just provide some introductory remarks, and then we're going to get into an interactive question and discussion session. So with that, Sean, would you like to start?
Sure, and thank you for the invitation to join today. For those who are not familiar with the GIIN, we're a nonprofit organization. We've been around for a little bit more than 10 years. We provide research that helps track the trends and best practices in impact investing. We develop tools and impact measurement and management, and we've got a community of a little more than 400 members at this point of institutions that work in the impact investing space and are interested in building the field. And as Diane mentioned, one of the things that we've been doing over the last 2 years has been running a working group looking at listed equities, because impact may have started in the private markets, but it's most definitely now moved into the space of public markets. The definition that we work with, which I think is fairly widely used within the industry, is thinking of impact investments as investments that are made with the intention to derive a positive impact. And what's important with that are two things. One is that impact is driven through the investment strategy, not as sort of a byproduct or sort of corollary to something that results from having other investment objectives. And second, that there's an active investor contribution in that. So what does that mean for us when we've tried to look and work with our members and our wider network around public equities? Because in our view, if we're introducing funds that identify themselves as impact in the listed equity space, then they should do something new and different, because we have had very successful sustainable investing products for 50 years now that have been built around evaluating companies off of a range of environmental and social factors and engaging with them in active stewardship. And I think from our experience or engagement within the topic, what's important is kind of making a distinction between investments that have an impact, so most sustainable investing has an impact, versus investments and investment strategies that are designed to drive a specified impact or an intended scope of impacts. So if you look at some of the successful engagement that's been done over the years with companies like Nike and Walmart, it has clearly had an impact. However, very often the purchase or the entry into those stocks was driven by a wider sustainable investing strategy rather than the need to engage with companies, those specific companies, on aspects of their supply chain or aspects of their product. So in terms of what have we taken away, or where has our working group landed, as Diane said, there's no one thing that we've been able to identify that distinguishes an impact fund from a non-impact fund. It's not about a specific kind of engagement. It's not even necessarily about owning a specific types of companies. It's a combination of things, but there are three aspects that we've zeroed in on through our working group process. And I'll just mention these quickly as a way to sort of end my opening comments. The first one is that the strategy of the fund needs to articulate some clear impact objectives. If you look at a lot of sustainable investing over the years, it's had a broad goal of investing into companies that provide an attractive financial return and align with universal human rights, or align with broad sets of norms, or are the best in their industry. That's a very different proposition from saying that you've got a strategy that's designed to try to accelerate a particular transition or solve a particular set of problems. The second is that statement of strategy needs to be clear enough that the fund manager can develop a theory of change that can go with that stated impact objective. By theory of change, what we mean is basically a thesis of the following types of actions, the following types of investments, the following types of market changes will probably lead to the outcome that I'm looking for. So if you think again broadly of we're investing into sustainable companies for a better world, that's a broad thesis that if we have all companies do the best at everything, then that will lead to a better economy. It's quite different from saying I have an investment strategy to support a transition to a low carbon economy, or an investment strategy to design or to ensure that there is a sustainable safety net for wide cross sections of society. And then the last thing is that strategy in terms of reference should then be the drivers of the mechanics of the investment process. They should be the drivers of the portfolio construction. What do you acquire? How long do you hold it? When do you exit? They should be the drivers of the focus of engagement, what you choose to engage with companies on in the portfolio, and the focus around how you approach performance measurement. They should provide some sort of an external reference or some sort of a guidance point in terms of what the fund's trying to achieve that can then influence the choices about what matters when you're looking at performance measurement for the companies. Now, that's likely going to result in portfolios that would look different from a typical best-in-class sustainable fund that's trying to find breadth across all of the industry sectors and the best companies within it. But that's actually probably a good thing, because it means that it's an investment strategy that's doing something different from a financial perspective and from a sustainability perspective.
So, look, I think Sean made a lot of great points. Hopefully I'll try not to reiterate many of them, but I think, generally speaking, we agree with many of those things, right? I think our approach to impact in public markets is really to look for investment mechanisms or strategies or specific asset classes that can really deliver positive change, right? So across the portfolios that we manage on a discretionary basis or advise our clients on, so we're always looking for opportunities to generate, real-world tangible impact across the different asset classes within diversified investment portfolios. And I think the thing to recognize is that public equities and public fixed income do represent the majority of many investor portfolios. So they represent, significant opportunity in areas that we continue to actively explore for driving real impact. But I think when we think about the objective of impact investing and some of the things, Sean was referencing, with an end investor and what you want to achieve, regardless of the asset class within a portfolio, we do have expectations around how strategies should be managed for impact as well as financial performance. So that any of the investment solutions that we implement in portfolios are actually managing to drive incremental positive change versus, the counterfactual if not. So the types of things that we tend to look for, and again, echoing a lot of what Sean said, are evidence of intentionality, right? Measurability of the targeted impact that's being looked for, theory of change, additionality of the capital, as well as an investor's actions to actually drive that change. And so, as referenced, I think the key mechanism that we all see for driving these elements in public equity strategies in particular is intentional engagement around driving strategy changes or operational ESG footprint changes according to a specific theory of change that's been developed in advance of making the investment. And I think in our view, that's the key differentiator versus, kind of thematic strategies where there might be strong alignment of the business models of the underlying enterprises to positive outcomes, but you don't necessarily see additionality from a fund investor or his or her capital. So, I think the idea that you get secondary markets exposure just means, again, the invested capital isn't actually going onto the balance sheet of companies not actually driving any change, and there's not deliberate fund investor contribution, excuse me, to drive any of that change. So maybe just a couple of points on opportunity set. From an opportunity set standpoint, we think that there is scope for improvement and change that can contribute to impact across all types of companies. I think there's an argument out there that there are greater opportunities for change at small and mid-cap size companies rather than large-cap companies, in emerging markets rather than developed markets. And maybe in some of the industries that are perceived as being the dirty industries or the more harmful industries. But in general, the way that we think about it is there's scope for change, for positive change across all companies, both from an operational standpoint as well as from a products and services standpoint. And so we'll look for that, in lots of different areas. Potentially, though, focusing on some of the areas that I did mention where there might be greater scope for change and therefore greater scope for that associated financial return as well. So what we've done is we worked with a number of external fund managers to develop engagement-focused strategies in public markets, specifically focused on SDG challenges and demonstrating, measurable positive change against some of those opportunities. So, looking forward to digging into this deeper. I think there's still a lot of work to be done to flesh out what good impact looks like in public markets. But I think some of the key components, as we went over, are, that development of the theory of change around it, working actively through engagement with company management around these very specific issues, managing against very clearly set objectives. And I think that's the key differentiator against a lot of the thematic type strategies that we see in the marketplace today. So back to you, Diane.
Thanks so much, Andrew. And Quyen.
Thanks, Diane, and thanks so much, Sean and Andrew, for going over so much of the criteria that we also adopt at BlackRock. So at BlackRock, we're a global asset manager, and we have set a high bar with established minimum criteria for impact investing across asset classes, which includes private markets, public markets, equities, and bonds. Our focus on public equities today is near and dear to my heart. I've been in this space for almost 10 years, even before the SDGs were adopted. And at BlackRock, generally, our view is buying and selling stocks in the secondary market, specifically in public equities, that's insufficient to conclude that impact's been created. And if I had to identify the single most criterion, in addition to other criterion, but the single most criterion for impact investing, that would be additionality. So additionality in this context means, but for that contribution, that activity, that outcome likely would not have occurred, thereby creating impact. It's the key criterion for an impact approach across any asset class, and articulating that additionality helps capture that theory of change, that important theory of change that both Andrew and Sean touched upon. So within public equities in particular, I believe that impact has got to incorporate additionality at 3 levels, not only at the company investee level, through their products or services, but also at the asset manager level. So this is the investor contribution part to impact, and also, of course, at the asset class level. We know that public equities has the capital that can be deployed to create and mobilize change a lot faster than the limited amount of capital we see in private markets alone. So let me focus on additionality just at the company level and then at the investor level, which has the backdrop of capturing that theory of change. So at a company level, the primary source of additionality are the application of leading technologies, right? But also the innovation need not be just through some leading technology. It could be innovation at the business model level. So a real estate company, through their innovative business model, can bring affordable housing to an underserved population, for example. And then, of course, a third source of company that additionality that we often see is the company's ability to bring essential products and services, basic needs to underserved populations. So that's at the company level. If we were to look at the investor level, and then I'll pause right after this so that we can dive deeper into some of the questions that are on top of mind. But at the investor level, so asset management level, it's critical that we have a theory of change on what we can do to drive impact. And so within public equities, there's a set of 5 activities we've identified. We can use any one of these or any combination of these 5 tools, depending on where a company is in its business life cycle and what it needs to create additional impact. So first, we have to invest with a long-term mindset. That's fundamental for us to deploy the other 4 tools. The second is to help create a better marketplace for impact companies that seek a responsible exit from private markets. The GIIN published a paper a couple years ago on the need for responsible exits. And one of the ways in which private market impact companies exit the private market is, issuing an initial public offering, entering the public equities market. So when we seek to be anchor investors, long-term investors in these new public offerings, that helps create that marketplace for responsible exits. The third tool is to invest capital. When a company needs to raise additional capital, there's a myth that once a company becomes public, it doesn't need capital to grow. The original angel investor capital, private equity, venture capital asset. But we've seen in public equities as well as bonds, companies often issue subsequent rounds of capital raises, through debt, through equities. And these capital raises are only available to institutional investors and high net worth investors. And so by participating in these capital raises, we're infusing the companies with the capital they need to grow and scale their impact as they are further along in their business life cycle. And the difference in capital is from millions to the billions. So it makes a big difference. And then the fourth, of course, is engagement. We've talked about that. And we'll go a little deeper, I think, into engagement and exactly what type of engagement counts as impact. And then, of course, with impact investing, we know this is a nascent market. And so within public equities, when we're able to bring much needed visibility to these underserved, covered impact companies, they're less covered by sell-side analysts, for example, versus traditional equities. That additional visibility helps bring attention, to both their impact as well as their, financial investment attractiveness. So these are 5 tools that we can deploy. Engagement, there's all sorts of engagement. I hope we can go into that a little bit further, but at the asset manager level, the additionality that we can provide, the additional investor contribution, capturing that theory of change is essential.
Thanks so much, Quyen. You gave there's a lot of information in there. And since you focused on contribution, let's just jump into that a little bit more. So Andrew, you're from an asset owner perspective, and how you evaluate contribution may be different than, or maybe similar to what Quyen has described. And Sean, based upon your experience with the GIIN and the working group, it'd be interesting to hear both of your perspectives on contribution. So Andrew?
Yeah, sure. Thanks, Diane. So look, we focus on investor contribution and specific again to the capital and the engagement that we were talking about. I think that's really the differentiating factor that drives impact above and beyond baseline. And so it's really about how impact's incorporated into the core of investment process and strategy, again, with a view towards how it's actioned through engagement. So looking for, what a fund manager or an active investor is doing pre-investment, during the holding period, thinking about the engagement and how that's actually driving impact with corporate management and how impact's actually measured and managed, right? So if you think about, I was talking about thematic strategies before as a distinct separate allocation within portfolios. Whereas an investor, you do want exposure to underlying companies where their business models that are contributing positively to social and environmental outcomes. I think you can have a theory of change around what types of companies are really doing that in the right way. And you've got exposure there, at least we do in our portfolios, to fund managers who are selecting companies whose products and services are specifically aligned to sustainability goals. But I think, in this particular allocation, we have a distinct allocation to engagement to drive impact. We're really talking about investor contribution through engagement. on specific sustainability objectives. And just to be clear, I mean, those are objectives that go beyond disclosure, right? Aiming for a focus on deliberate strategy change or operational change to drive really tangible real world outcomes. I mean, I think that for us is the necessary mechanism that we're looking for to realize impact in public markets. So when we think about the impact principles, we think that engagement really helps to deliver against all of those different elements that we're looking for. So, look, investor contribution is the key. I think developing that theory of change, both Sean and Quinn mentioned that it's essential, and really looking for how, you take the idea of driving positive impact from an end investor asset owner perspective all the way through to implementing it with demonstrable metrics so that we know that it's being measured and managed, and that impact is actually being achieved. So the solution actually matches the intention of the investor.
Thanks, Andrew. Sean?
I'd say contribution was one of the most difficult questions that our group has talked about and that I've been around. I think everybody agrees that investor contribution is an essential part of an impact strategy, whether it's public equities, bonds, private markets, whatever asset class you're looking at. Where they tend to disagree is what actually constitutes credible investor contribution. And in listed equities, what's particularly difficult is that in most cases, the contribution is most effective when it's done in a collective way. So if you think about engagement's usually most effective when it's coalitions of investors rather than a single investor alone. And so on. But I think the list that Quinn offered us of sort of the 5 approaches which BlackRock, 5 ways of activities that BlackRock thinks about, I think is very helpful. It's quite similar to the conversations that we had. I mean, I've basically heard sort of 3 ways in which people talk about contribution, and I think they do align quite nicely with what was already shared. The first is contribution via active engagement. I think that, as I said, you can debate whether or not an individual investor has a significant contribution on their own, or they need to be part of coalitions. That's a separate conversation. But engagement, I think, is one thing that people look at, and particularly I'd highlight what Andrew said about engagement that focuses on asking for specific strategic or operational changes that are directly tied to the strategy of the fund or the impact strategy of the fund, and that the fund manager can justify based off of the theory of change for what they have in mind. That doesn't exclude doing other types of engagements as a fund manager for other reasons. But if you're a low carbon transition fund, for example, then the bulk of your engagement that relates to impact needs to be the strategic and operational proposals you put to companies in the different industry verticals about the steps that they should be taking. Second area that people talk about probably is the other 2 areas are around sort of the use of capital. One is injecting new capital into companies. I think that the point is a very valid one, that listed companies, certainly at IPO, and sometimes young companies do continue to do capital raises, and that's no different from the private markets. So there are opportunities to provide new capital in public markets. And then the other argument that people would make is around providing patient capital, because being able to provide some consistency and stability to share price, or even upward support to it, can enable a company to do other secondary capital market operations and use that share price in other ways that bolster their financial position and enable them to do more. As I said, the debate, everybody agrees that contribution is important. Where I find that people debate is less about are those channels through which you can have a contribution, and more differing opinions about what's the threshold in order for something to be credible as a statement that the investor is making a contribution.
Quinn, do you want to follow up on what Sean just said on contribution?
Yes, would love to. And we've talked about this, Sean, a couple of things already together. What I think I might do, Dan, is offer an example to highlight, some of the key points that Sean's made, because it is, I do believe that there's really good intention among, all the players in the industry, but, there's accidental impact washing, accidental SEG washing. And so hopefully, this could be helpful, but, there's all types of engagements, You can engage on ESG, issues, better disclosures, more board diversity, and a lot of, to Sean's point, there's a lot of engagement from many different asset managers on the same topic, oftentimes, for the same company. So how do you know that your engagement has actually made a difference? So to us, that's ESG engagement on the company's operations, the how of a company. For us, in our impact-specific strategy, we also deploy specifically capturing that theory of change, an impact engagement strategy, which we coined Impact Engagement 2.0. That's not very innovative, but it complements ESG engagement. So we focus on products and services, creating additional impact. So here's the example, and it focuses again and illustrates additionality. We have an outcome that we seek, in this engagement that we're targeting. So basically, our Impact Engagement 2.0 strategy. In the strategy, we introduce companies to each other when we believe that both can benefit from working together through their impactful products and services, and consequently that increases their collective impact and arguably enhances their business model. So one such example is an education company. So we have an education company, job training, that has a job training platform online. It's based in the US. And then there's another company focused on matching job seekers to jobs in Asia and Australia, including emerging markets. That's its dominant footprint. And the US-based company was looking to expand its geographic reach beyond the US to provide education services to a broader group of people. And then this job placement company lacks that educational platform to enhance the skills of its clients, its job seekers, as well as students. And so we introduced them together and allowed them to work together towards what would work best, in a synergistic, complementary way for both of them. We know that we can attribute any outcome to our introduction and idea of matching them together. So we're matchmakers in this particular example, but that's one type of engagement that's often different than what we see, in just ESG engagement. They're both important and they're complementary, but one can be linked, the Impact Engagement 2.0 strategy can be linked to additionality and that theory of change.
Oh, that's great to have that example. So what I've heard so far is that you really have to have a defined intention. It's not just a general, you're really targeting an intentional impact. The contribution, engagement is important, but as you stated, Quyen, it's got to be broader than just engagement. You have to have a demonstrated, what'd you call it, an active engagement that shows a credible contribution. And Sean, you mentioned that you also have to set up your impact management measurement system so that it's actually going to be able to quantify what you say you're targeting as an impact. And that's great for defining what needs to be done, but I think we've all expressed the concern about the potential for impact washing in the publicly traded equities market. We've seen this occur, and with the advent of the EU taxonomy and SFDR Article 9, where there are many funds reporting under Article 9 that may start to call themselves as impact funds, which we would not necessarily consider investing for impact in the way that we look at it at the impact principles. So how do we better mitigate this risk of impact washing in publicly traded equity markets? That's a very broad question. There's probably not one answer, but I'd love to hear your views on how we kind of make this a much more disciplined venture into public equities. Whoever would like to answer that first.
I could offer a couple thoughts at first. And I'd also say, if we're talking about sort of labeling and categorizing, it's worth just mentioning the proposal that the US SEC has recently released, which is actually quite different from what the European Commission has done in some interesting ways that I think personally have got some benefits or advantages to them. But I'd say, how do you avoid impact washing? One thing is, I think asset owners need to take an active role in terms of better articulating what they expect out of their investment funds. I think there's a lot of confusion that people refer to around the different labels and so on. I think that's in part because quite often we're using labels as a shorthand to try to avoid laying out quite specifically, how do you want environmental and social factors treated in your investment process? What are your objectives around it? So first thing is, in terms of being able to avoid or reduce some of the impact washing risk, is clarity from the asset owner side on what objectives they have around the use of environmental and social information. That then puts you in a much better position to have a thoughtful conversation with an asset manager about the particular strategy that they're offering, and whether it's one which is aimed at just managing risks, whether it's one aimed at financial optimization, whether it's one aimed at addressing particular transitions and such. The second thing is, I would say, is both asset managers and asset owners need to embrace the idea that there are differentiated purposes for sustainable funds, and that when we're using these labels, it is with the intention of being able to better describe different tools in a toolbox. It's not a better or worse type of a statement. It's different tools for different purposes. And I think being more explicit in those expectations, then when you start to have things like the types of asset class guidance that we develop, or the types of tools that other people provide that help describe processes or methodologies for how you can pursue different objectives, then starts to make a lot more sense, and also become a lot, brings a lot more structure to the market and the conversations in the market.
That's very helpful. All right, since Sean says the asset owners really have to step up and be more direct about what they're looking for as an asset owner, as a large asset owner, how do you respond to that, and what are you looking for, and how are you pushing your managers in that way?
Yeah, I mean, that's a great point. I think that I'd agree with everything that Sean laid out, right? I think there are differences, right, in terms of diversified strategies. Some asset owners might be looking for diversification impact, in a diversified way. Others might be more specific about particular objectives, looking for decarbonization specifically, or advancement of objectives on, the SDGs, for example. So I think it is about clear articulation. What we've tended to do is keep it a little bit broader, and use the SDGs as a specific frame of reference around impact, and identify, certain ones where we think there is the potential for more positive change, particularly in public equities, but have it be a little bit more diversified, and then look for fund manager capabilities that can really drive change on those objectives. So I think it is about identifying particular goals, and then looking for, as I think Sean was referencing, investment process that very clearly drives change towards those, and is able to articulate that over time, right? So from the beginning, in terms of the theory of change around the specific objectives, and then demonstrating with specific examples, as Quinn was kind of getting to, on a case study basis, how individual companies, or how they're contributing to the investment, the capital, and the investor engagement are actually contributing to positive change, and measuring and managing that over time. I mean, I think that's one of the key things, is these tend to be longer dated in terms of the expectation around the time period of realization of impact, and just making sure that there's consistent communication around progress towards goals and what those goals are, over the space of what tend to be multi-year engagements, and then what impact is actually realized, as opposed to just looking at the outcomes piece of it. So that's the expectation from our side in terms of what we want. I don't think that there's anything perfect out there in terms of engagement around impact specifically, but I think we are starting to see better evidence of that process being consistent for individual companies within a portfolio, as well as, importantly, the overall portfolio. So I think that's something also on a going-in basis to establish, what are the objectives that the asset owner has, again, around specific themes, or more diversified, and whether the fund is taking that same portfolio approach, or whether it's opportunistic on a topic by topic, company by company basis. But I think that's what I'd say from an asset owner perspective, laying out those clear expectations, it makes it a lot easier. And frankly, as we were saying before, there aren't as many strategies in the public markets that do focus explicitly on impact, that follow the principles. And so in many cases, it's actually more of a co-development type of situation, where an asset owner will lay out the expectations, and fund managers are developing strategies around those specific expectations.
Thanks, Andrew. Yes, that's something that's come up a bit. If the asset owners are demanding that their managers actually follow the impact principles, that is one way to raise the bar of rigor and how they're actually investing for impact. One question for both you and Quyen is, we know investors sometimes, even though they're dedicated to impact, those short-term aberrations like the markets that we've seen thus far this year sometimes test people's commitment. So are you finding that some of your investors are maybe losing patience for impact because it is definitely patient capital, or do you find that they really are not focused on the returns that many traditionally been focused on?
Well, I can start. I think that it's a balance, right? I think that everyone's looking at performance, and during market volatility, it can be difficult, but I think investors that are focused on impact outcomes and are articulating that very clearly do have a view towards the long term. So I think that's where, regular reporting on progress towards objectives can be very helpful in making sure that, the impact piece of it or the sustainability piece of the strategy is on track, even as you're seeing, the reflection in public markets on a day-to-day basis, of financial performance. But if the objective of investors going in is truly a dual objective, then I think that interim market volatility will certainly affect the way that people think about things, but that consistency of capital that we talked about from an asset owner perspective, I think is really important for fund managers as well, so that companies actually recognize that that capital is there for the long term and driving towards both financial performance from a long-term perspective as well as the impact that's desired. So, not easy to look past market volatility in many cases because people are focused on both, but I think that reporting piece of it can help with managing some of that.
Great, thanks, Andrew. Quyen, I'd love to hear your perspective as an asset manager.
Yes, and if I may, I'd love to share a quote from one of my professors who teaches impact investing when I was in graduate school. He said that impact investing is providing patient capital by impatient people. So we're impatient in that we want the change to happen, but the capital must be patient. And I would say, despite market volatility, of course, we're sticking through it for the long term, and our clients, thankfully, have that same alignment. So we haven't been deterred by that. Now, combining this with your earlier question on how to discern, accidental impact washing from impact strategies, especially in public markets, and your point on operating principles, and Andrew's point, definitely, I think, being a signatory of the operating principles can help discern whether a strategy captures the best practices and requirements for impact investing, including investor contribution, as well as best practices in measurement, before, during, and after an investment. And that will help with that patient capital as well. But absent being a signatory, there are things that you can look for, and I would point to that same one criterion, additionality. Just ask yourself, what's the additional contribution to that impact, to that progress that the asset manager is providing in addition to, their deployment of capital. So additionality, just asking yourself that will help.
That's great, thanks. Quyen, you had touched on a topic earlier that I just wanted to get back to, and that was about, the types of equities that are more appropriate, or it's easier to invest for impact. And we can talk about market cap and just different kinds of strategies, trading, holding. So would you like to just touch on that, the market capitalization, how that may play into being able to invest for impact?
Mm-hmm. Yep. So our strategy seeks to invest across all caps. That said, because of our strict criteria for impact investing, additionality being one of them, it tends to narrow our investable universe to small mid-cap companies. Though there are a handful of large cap companies, some very innovative telecom companies, providing mobile money services as their main growth driver, for example, in emerging markets. Those tend to be larger cap companies. But because additionality is one criterion, but then the other one that's really important is materiality. And that's what narrows our universe down to smaller cap names, small mid cap names. And materiality, it just means, the actual product and service must constitute the majority of the business. So one way to measure that is through the requirement of 50% revenues or EBITDA coming from those products and services. And the reason why we want it to be at least 50%, but oftentimes it's a lot higher than that, in the 80s, 90s%, or even pure play companies, is because we want that impact to be the focus of management. We know that oftentimes, if you just look at business models and business strategy, oftentimes a company's capital allocation, it has limited resources, and so the decisions on capital allocation as well as human capital allocation often goes to where the business is most focused, its core business. So if a company were to have impactful products and services, which is terrific, but it's only 5% of its business, the rest is neutral, or the rest is not impact, we cannot invest in that company because our criteria that we set forth, requires at least, majority of its business. And so because of that criterion, materiality, on top of additionality, and of course measurability, we tend to find most of our investable universe within public equities globally, emerging or developed markets, to be small mid-cap companies.
That's very helpful. I love your point about materiality. That's something that you don't hear a lot of. So it's nice to hear that that's part of your criterion for investing in companies. And Sean, I wanted to go back to you because the paper that you published last year in 2021, I know you're doing an updated version, and it would just be interesting to hear, are you noticing any change from the first paper to the draft that you have available for review now? Is there anything that really struck out to you?
I think that probably the biggest change was the focus on theory of change. That you wouldn't see that very visible in the first paper that we produced. We were trying to approach I think, from a more mechanical perspective of saying, if you take the stages of the investment process, there's probably something that you could find that would in effect be your criteria that tick off. And as the working group was progressing, we kept coming up with these examples that people would throw out of, like, okay, bicycle manufacturing, is that an impact investing? It fits into a lot of visions about low carbon futures, and but it somehow doesn't quite seem like the type of impact product that most people think about. And there are lots of bicycles that are sold that aren't specifically for the purposes of low carbon transitions and so on. So we had lots of examples that were coming up along those lines. And sort of different situations. And we kept coming back to this thing of, well, it sort of depends on whether or not you've got a rationale for why that investment as part of a wider portfolio of investments will add up to a transition. And if you could actually, because we could imagine some circumstances in which you could argue that, if you take bicycles as an example, a particular bicycle manufacturer that has a particular focus, and maybe it's particular regions or particular types of products, as part of a wider portfolio that's about transitions in mobility, actually starts to make sense as being part of an impact theory of change. Whereas if it just sort of sits alone in a portfolio alongside chemical companies and 50 other sectors with nothing in common, it's a lot harder to argue that there's an intention, an intention in there. So I think that's probably the biggest transition, the importance of having not just that statement and a strategy about what you're aiming for, but an actual roadmap about what sorts of investments, because then that leads you into the types of questions that Quyen was just talking about. Which asset classes actually make sense for the different problems we're addressing? Which parts of the world? Which industry sectors? You can come up with a very diversified portfolio around things like low carbon transitions, around things around social safety nets. But there needs to be a logic that ties it all together.
That's great. And this paper is available to review on the GIIN website currently, correct?
It's available through the end of August, and then it'll be taken down briefly as we review feedback and comments that we get, and then we'll have a for final product in the last quarter of this year, hopefully October, November timeframe.
Great. All right, I'd like to give everyone, this has been a great discussion. I think you've really provided some clarity on what it means to invest for impact in the publicly traded equity market. It seems that we've got to get the word out more, and I think leaning on the asset owners and helping them educate their asset managers is a key part of that. But I'd love to hear, concluding remarks from all of you, and just what your key takeaways are and what you'd like people to take away from this webinar. So I'll start with you, Andrew.
Sounds great. Thanks, Dan. Look, I mean, I think, as an asset owner or advisor to investors, I think everyone clearly recognizes that there's significant scope to drive positive change on social and environmental challenges in listed equities. But I think, as mentioned today, it's really about the threshold expectations that we have as asset owners and asset managers for what constitutes impact, what can really drive impact credibly across all of those strategies. I think anecdotally, we very clearly see the shift in investor mindset across the spectrum continuing to shift towards that desire to drive positive change. So I think Sean's comments about which asset classes are most appropriate to drive positive change towards which challenges, I think that's a really important one. I think clearly investors want to see as much impact as possible across all different asset classes, but I think the recognition that certain strategies can drive perhaps more impact in certain asset classes, it's a good one. But I think listed equities has a lot of scope for it. I think the last thing that I would say is just that as asset owners looking across a lot of different asset classes, strategies, and so forth, I think having something like the principles really helps to achieve consistency in terms of looking at, if these are my impact objectives as an asset owner across a whole portfolio with different strategies out there, with the principles, it's a little bit easier to compare, what investors or what fund managers or what strategies are doing in each different part of the portfolio or each different allocation, and how that helps contribute towards consistent impact, across portfolios. So it's something that's really helpful for us that we've incorporated into the diligence processes. But I think it's flexible enough that it's not prescriptive, and it allows for different asset classes, including unlisted equities, as well as different fund manager strategies and approaches to really drive impact.
Thanks, Andrew. Quyen?
Yes, thanks, Diane. I would say, the one thing I love about working in this space is everybody whom I meet really wants to make that difference. It's hard to know which tool you should use. There's so many acronyms, right? And there's so many frameworks, all these criteria. I would say, absent that perfect framework, absent the perfect set of criteria, until Sean and the GIIN's paper is released, so we'll look forward to that, you can still get started. Just getting started, keeping in mind just one or two key things that you care most about, whether it's the SDGs, additionality, investor contribution. You learn by doing and you refine. And so get started. The measurement part, it's not going to be perfect, but of course you can create impact without measurement. We've done that for decades, And so, you can just refine, get better, and get better at communicating it. So I would say, don't hesitate, just jump in and ask questions.
Thanks. Sean?
Yeah, well, thank you for an interesting conversation today. And I guess my final thoughts would be, an impact fund should be another tool in a toolkit. That's not a better or worse statement, but it should be a distinct tool in a sustainable investing toolkit. And so there should be visible differences in impact funds in terms of the strategies, in terms of the investment processes. And they should all be tied together with a theory of change. And so I think it's, there's lots of opportunity of what could be done within the listed equities asset class. I would agree with Andrew's statement. I don't think we've seen anything yet that is a complete version 2.0 or of a completely different approach or complete innovation in terms of how you'd approach impact in listed equities. But we do see some really interesting steps forward in that direction. And some institutions that are really trying in a very dedicated way to figure out how they could most effectively pursue impact in the listed equities asset class. So I think that people should, both on the asset owner side, that they should welcome and invite those differences and kind of be clear in terms of what they're looking for, and give the space for the asset management industry to offer something that would be a different product would offer a different set of or a different portfolio to be investing into, and will offer different kinds of returns in every sense of the word.
Right. Thanks so much. And that you said that well, Sean, that it is just one distinct tool in the entire investment toolkit. There's many different ways of investing sustainably, and impact is a very specific way of doing so. And we hope that this webinar has laid out how you distinguish between the different types of investing, and particularly how do you invest for impact. I would recommend that people look at the disclosure statements that are on the website. You can look at the BlackRock disclosure statement, which is very precise about how they invest for impact in the public equity markets, as well as other asset classes, and also how UBS as an asset owner then arranges their impact management system so that they are ensuring that they are investing for impact for the strategies that they've selected. And again, I welcome you to look at the GIIN's report, which is really helping enhance the knowledge of what it means to invest in the public equity market when you're investing for impact. And with that, I want to thank all three of you, Andrew, Sean, and Quyen, for being here and helping share the knowledge and share the best practices for this market. I look forward to seeing you on the next webinar.